Stocks in 2022 are off to a terrible start, with the S&P 500 down close to 20%, Dow Jones down 16%, and the Nasdaq down 12% since the beginning of the year. Investors in big tech are growing more concerned about the economic growth outlook and are pulling back from risky parts of the market that are sensitive to inflation and rising interest rates. While stock market volatility is normal in the short term, a market weakness so far in 2022 has investors worry about the stock market crash. Hi, my name is Gio, hope you're doing well. In today's episode, let's look closely at why stock market keeps dipping and what is hitting next. Let's get right into it. The past couple of years has been quite exciting for many investors. After the stock market crashed at the beginning of COVID-19 pandemic, it's been on a pretty good run. The S&P 500 climbed by 16% in 2020 and nearly 27% in 2021. Many individual investors rushes into trading, getting into meme stocks like GameStop and enjoying the benefit of a pretty massive bull market. Some dipped into cryptocurrencies like Bitcoin, which traded about $60,000 per coin in 2021. Tech companies from Netflix to Amazon felt like pretty sure best for growth. All this fear and uncertainty about what's coming next has led to the potential of another stock market crash, the first since the start of the coronavirus pandemic back in 2020. So, will we see the stock market crash during the rest of 2022? Let's take a look at some of the major factors to better understand where the market is going. What is a stock market crash? A stock market crash refers to a sudden and substantial drop in stock prices. Stock market crashes are often the result of several economic factors, including speculation, panic selling, economic bubbles, or major catastrophic events. While there is no official threshold for what qualifies as a stock market crash, a common standard is a rapid double-digit percentage decline in a stock index such as the S&P 500 index, Dow Jones Industrial Average, or Nasdaq over a couple of days. The effect of stock market crash can have a major impact on economy, affecting everyone from retail investors to professional traders to institutional and fund managers to those saving for retirement, and often take a significant amount of time for a full recovery. Note that there is a difference between stock market crash and a bear market. The bear market term also refers to when a market experiences an extended period of price declines. However, stock market crashes are typically more unexpected. Although it's common for bear markets and stock market crashes to occur simultaneously, it is possible to have one without the other. While no one can predict exactly when a stock market crash will happen, there are several things that we can look at. First of all, speculation. Speculation can cause stock prices to become overvalued and asset bubbles to form. This happened with mortgage-backed securities that led to the 2008 financial crisis. After an extended period of economic growth, stocks could show high price-earnings valuation compared to long-term averages. Price-earnings ratio often peak before a downturn. There could be a sudden and catastrophic event like supply shock or natural disaster like what happened at the beginning of the COVID-19 pandemic in March 2020. And then there are those causes that are not that easy to identify. They are simply the result of poor market sentiment because of the economic condition, such as during a bear market. How does the market crash and where does the money go? During a stock market crash, equity prices collapses over a course of one or few days. The market declines is rapid. Investors fear the worst and attempt to liquidate their position or convert them to cash. A stock market crash can be short-term or it can take years to recover from, extending to a recession or even a depression. Investors who have placed large bets using margins, funds they do not own, get particularly hit during market crashes, as they are forced to face margin calls and thus can experience exponentially greater losses than their original investment. Let's look at the biggest stock market crashes in history. The first one, the Wall Street crash of 1929, was the most severe. The Dow fell 23% in 2 days, sparkling the Great Depression. By 1932, the Dow will lose 85% of its value. October 19, 1987 came to be known as Black Monday following the first financial crisis of the modern globalized era. The Dow fell 22.6% in 1 day. The 9/11 terrorist attack the S&P 500 fell 14% in 1 week in September 2001. The 2008 financial crisis, which was fueled by the US housing market bubble, saw the S&P 500 climb 20% in 1 week in October 2008. During the 2020 global pandemic, the Dow fell 12.9% in 1 day on March 16, 2020. 6 risk factors that could trigger a market crash in 2022. First of all, high inflation. The US economy is experiencing persistently high level of inflation. Inflation, measured by the Consumer Price Index or CPI, is the rate of changes in prices of goods and services over time, and prices have been continuously rising, contributing to stock market volatility. The latest CPI reading increased 8.3% on an annual basis, near the highest level the American consumers have seen in more than 4 decades. Meanwhile, higher prices for raw materials, inventory, transportation, and labor have affected corporate balance sheets. While companies' earnings in 2022 have largely grown, inflation troubles have hurt profit margins. High inflation reduces consumer confidence and can slow economic growth, depressing the share of publicly traded companies. If you want to know how to protect your portfolio against inflation, you can check out this video. Rising interest rates. As inflation is a major economic concern, the Federal Reserve is trying to maintain a target of 2% of inflation over the long term, and will likely continue to tighten monetary policy. When inflation runs too hot or asset bubbles get out of hand, the Federal raised interest rates to cool things off. Higher rates ripple through the entire economy. Mortgages, car loans, and business loans become more expensive, slowing down cash flow. This can lead businesses to pause any plans for growth. In the stock market, higher rates can encourage investors to sell assets and to take profits, especially in times like now when there have been few years of double-digit percentage returns on stocks. As you might guess, investors' decisions like this can lower stock prices individually, at least if not across major market sectors. If you want to learn more about the Federal Reserve and interest rate, you can check out this video. Russian-Ukrainian War. Russian invasion to Ukraine has contributed to short-term stock market volatility in the United States and around the world. Many countries, particularly in Europe, have been reliant on Russian energy exports that have been disrupted by the war. Now the European Union is moving towards an agreement on a Russian oil embargo. The US issued a ban on imports of Russian oil, liquefied natural gas, and coal in March, and has been working to increase domestic resources. Russia produces roughly 10% of the world's oil, and even with increase in US oil production, prices are likely to remain elevated in the short term. Inflated oil prices have been an issue for US businesses because they drive up transportation and manufacturing costs. They can decrease companies' growth expectation and lower earnings, which affects stock prices. If you want to learn more about the economic impact of the Russian invasion of Ukraine, you know where to find the video. Supply chain issue. Global supply chain are the network between companies and their suppliers needed to turn materials into the products they sell. Massive supply chain shortages appeared during lockdown that shut businesses around the world and kept workers at home. The supply chain issue we are experiencing today aren't in just one sector. In fact, a significant number of businesses are dealing with delays across the economy, from manufacturing and retails to healthcare and transportation. There were hopes that supply chain issue will start to recover in the first half of 2022 as the effects of pandemic became contained in more countries. But other events, such as the war in Ukraine, have added new restrictions. And with lockdown in Shanghai and other key cities across China, pandemic effects are hurting supply chain again. Some of the industries most significantly hit by global supply chain shortages include shipping, semiconductors, automobiles, industrials, retails, and restaurants. If you want to know more about the effects on supply chain issue, you can check out this video. Unsustainable labor costs. Some good news is that the unemployment rate remained at 3.6% in April, the lowest rate since February 2020. Still, there are millions of jobs available, but the low unemployment rate means the labor market is more competitive, which has led some companies to either pay up for their workforce or scale back on labor. Microsoft has increased pay to keep its employees, nearly doubling its budget. But the Robinhood market is cutting 9% of its full-time employees, like Netflix has laid off 150 employees. As companies are experiencing slower business and earnings grow, some have resorted to cutting labor costs. And the last one, we have weak earnings. Price inflation is putting pressure on corporate earnings, and as the Federal Reserve takes a more strict approach to its monetary policy, this in turn puts pressure on risky assets like stocks. While a majority of market sectors experiencing growth in 2022's first quarter, some companies are facing weaker profit margins. The consumer, discretionary, and financial sectors are reported year-over-year declines in earnings. Consumer discretionary has taken the biggest earning hit of all 11 sectors, falling 33.2%. Financials reported the sector's largest decline with a drop of 19.8%. More than 60 companies in the S&P 500 index have issued negative second quarter earnings per share. The bottom line is, as a result of market cycle, stock market crashes are a risk of investing. No matter how high an index rises, there is only so much it can grow before sellers take action. However, market downtrends don't have to result in a crash. While 2020's crash certainly won't be the last one the US will experience, it's not clear how long it will be before we see the next one. History has shown that the market always recovers from a stock market crash, even if it takes over 20 years to do so, as it did after the Great Depression, when it took the Dow until 1954 to finally recover from its losses. Still, the trend for long-term investors is always up. That being said, some investors view extreme volatility, even stock market crashes, as an opportunity to buy stocks with solid fundamentals at temporary reduced valuation. No matter what the rest of 2022 has in store, remind yourself on the things that you know to be true. You care about your family, your dreams, and your future. So make your investment decision with those things in mind. You will do a much better job of that if you stay positive and focus on factors that you can control. My plan for the future is to keep investing through dollar cost averaging, no matter if the market is going up or down. If you don't know what dollar cost averaging is, I have a dedicated video for that. Thank you so much for watching. As always, if you find this content helpful, smash that like and subscribe button, turn on the notification bell, and check out all the links in the description down below. See you in the next video.